Hi, everyone, and thank you for joining us for today's webinar, our 2022 Outlook for Endowments and Foundations. I'm Annie Deer, and I'm going to be the moderator of today's discussion. Before we get started, I just have a few housekeeping items to cover. If you have any questions today, we encourage you to submit them throughout our discussion using the questions box at the bottom of the screen. When we conclude today's prepared remarks, we will spend our remaining time answering any questions that have been submitted. If we are unable to get to your question, we will personally follow up with you after the event. For your convenience, a recording of the webinar will be available on our website within the next several business days. Now, let me introduce today's speakers. First, we have Nick Centennial, a senior investment consultant with Manning & Napier, who has been with the firm since 2006. Nick's primary responsibilities include providing analytical support to institutional clients in the areas of objective setting, cash flow analysis, and asset allocation. Our next speaker is Margaret Jeffries. Margaret joined Manning & Napier in 2012, working her way to associate in the client services department, and before joining the advisory services team in early 2018 as a wealth management consultant. Margaret is a certified financial planner and provides a broad range of financial planning services to our clients. These services include helping to develop strategies to meet near and long-term charitable giving and tax and estate planning goals. Our third speaker is Paul Stanzione, a portfolio strategist with Manning & Napier. Paul is responsible for communicating the firm's philosophy, process, and portfolio positioning across our suite of investment solutions. Paul is also responsible for working closely with our research department and conveying the firm's views on the economy, capital markets, and portfolio management. So we have a variety of participants on this call, from board members to staff and development professionals. And today, each of our speakers represent all of the different viewpoints that you might find helpful. Margaret works with your donors, so she knows how to help with financial and estate planning. Paul's focus is on investments and understanding the market, so you can know how it affects your donors' portfolios and the portfolio of your organization. And Nick works directly with nonprofits themselves, so he has insight when it comes to trends, fundraising, and planning for endowments. So today's discussion will be split into two parts. First, we'll recap what we saw in 2021 with respect to nonprofit organizations, donors, and the market. And then we'll dive into the trends we are seeing today that we think will help your organization succeed in the year ahead. So let's get started by taking a look at what happened in 2021 from a nonprofit perspective. Nick, can you kick us off by discussing some of the trends you noticed last year?
Yes, absolutely. Thanks, Annie. And thank you everyone for dialing in and joining. 2021 was a good year overall. You know, donors are still giving, and Margaret will talk about that in a minute. And investment returns have been great, and Paul will discuss that. But we are almost 2 years into a pandemic, and I think a lot has changed in that time. And I just think successful nonprofits have had to change too. You know, I work with a lot of different types of organizations, but if I really had to generalize, I'd say that many put a focus on trying to optimize last year, and I'd expect that to continue. So up here we have a few examples of what that means. First, there's been a lot of interest in growing or starting an endowment. I think donor trends have backed this for a while. People are getting older, and baby boomers, for example, are in prime ages for estate planning. But I think a lot of nonprofits have also identified this as sort of a vulnerability that they want to address too. You know, if there's any sort of permanence to your mission, it may make sense to have an endowment as an option for donors. It's sort of a natural selling point to be able to go to a donor who supported you for a long time and to tell them that there's this option to continue that support after they pass on. And then of course, you know, it's a huge benefit for your nonprofit too. The last recession really showed us that diversifying sources of revenue is important, and an endowment can definitely do that. That's why it's been a focus for many organizations. For those that already have an endowment and investments, there has been a trend toward probably reevaluating their policies for how that money is managed and spent. We've helped a lot of organizations over the past year take a fresh look at how they prioritize objectives. Asking themselves, are they too risky? Are they not risky enough? Are they exposed to inflation? Are they exposed to rising interest rates? Questions like that really filter into a portfolio's asset allocation. And with returns over the past 2 years acting as sort of like a test case, a lot of organizations are looking at how they've done, and they're wondering, should things have been done differently? And then the last one on here, staying connected to donors is another trend. To put a real simple spin on it, I think people are distracted, because there's so much going on. And with fewer personal interactions and fewer events, there are fewer opportunities to engage donors. Virtual engagement is good, but I think the worry is that it just hasn't led to the level of engagement that you might have had in the past. And that's been the feeling for many fundraisers. So again, it's just led them to try to optimize donor engagement as much as possible. And we'll talk about in a little bit a few ways that that's been successful.
Thanks, Nick. I think that those trends are definitely noteworthy. And I think what we've seen this past year in the market is also important to think about, especially when it comes to the growing interest that organizations have shared in starting an endowment. So with that being said, Paul, can you give us a recap of what the markets did in 2021?
Absolutely, I'd be happy to. In many ways, 2021 resembled the second half of 2020, just with the volume turned all the way up. In late 2020, we saw a really swift bounce back in markets, as well as the beginning of an economic recovery after the very swift and intense economic downturn that we experienced in early 2020. And then in 2021, those trends were sort of used as a launching pad, and the economy took off, markets took off even more, interest rates rose, we got a booming jobs market combined with supply chain disruptions because there just wasn't enough stuff for everything that people wanted to buy, so on and so forth. Because of a lot of that, as we all know, inflation reared its head and doesn't really seem to want to leave us. For a lot of nonprofits, 2021 meant a lot of success in a lot of ways, as far as generating return on their own invested assets, increasing their financial stability, but also seeing the financial position of their donors improve too. At the same time, there are rising risks and concerns as we look forward from here, such as, where can we go from here as far as returns go, after such a strong run that we've been on for the past few years, what the low and rising interest rate environment means, both for market returns in general, as well as nonprofit organizations and their assets that are invested. What impact could inflation have, whether it be on investment markets or on the day-to-day operations of your organizations? So that's sort of the backdrop of where we've been the past year, and we'll dig into a lot of these questions about where we may be going from here in a little bit, where we look at where markets may be headed.
Thanks for that overview, Paul. I think that the market has not only been a topic of interest for nonprofit organizations, but also for donors, since it plays a major role in how it impacts their financial decisions. So now that we're on the topic of donors, Margaret, can you tell us about some of the trends that you saw last year from that perspective?
Sure. So there was obviously a lot going on in general from all directions during the pandemic. But in the years leading up to that, I think donors have been impacted by changing tax laws as well. For example, the current estate tax exclusion of 12 million is about twice what it was back in 2017. So since it increased, there's been a little bit more of people kind of putting off maybe building in charitable gifts into a will or a trust, or even funding a charitable trust during their lifetime to kind of lock in the estate tax savings. However, at the end of last year, with the election and change in administration, there was tax proposals to obviously change the estate tax exclusion. Initially, it was suggested at 3.5 million. Now the current proposal is half of current levels, so about 6 million. That obviously would change things. More people reached out to us at the end of the last year trying to maybe lock in doing some gifting, setting up charitable trusts to take advantage of that $12 million exclusion. So definitely an increased interest in estate planning and setting up legacy gifting towards the end of 2021. Another big change that's been impacting donors, again, since about 2018, 2017, is the standard deduction when filing annual income taxes was also doubled. So it's about $25,000 right now for a married couple. Obviously, charitable donations have to be itemized deductions. So that means many people are not actually getting any tax savings from their annual charitable gifts. This is leading to a bigger need to kind of work with clients on annual giving strategies to find a way to both benefit them as well as fulfilling their charitable giving goals. Thankfully, even with these challenges and a bit of a decrease in what donors are able to save in taxes on a personal level, donations from all sources have continued to increase over time. For example, from 2019 to 2020, it rose by about 5%, and it's on pace again for last year. Numbers are still rolling in, but it appears to have also increased even further from 2020 to 2021. So that's good news for nonprofits, and still some opportunities to work with donors going forward.
Thanks for that insight, Margaret. Well, now that we've taken a look at what we saw last year, let's move forward with some of the trends that we're seeing today that can help your organization succeed in the year ahead. So one important trend that we're seeing is that organizations are showing more interest in building an endowment. So why is now a good time to start focusing on endowment building? Nick, can you give us your take here?
Yeah, it's rarely a bad time. but I think there are a lot of good tailwinds today that makes it an especially good time. I mentioned before, endowments enhance the stability of your organization, and most donors have acknowledged sort of the importance of that over from what's happened over the past 2 years. So there's that. They are another tool for donors to join in on your mission. We had a great webinar last year about planned gifts specifically, and Jack Simpson was one of our panelists. He compared planned giving to buying a car. Donors want different payment options to suit their needs. And endowment giving is sort of like an installment plan. Instead of giving all the cash up front, they want to pay in installments over time. And I really like that analogy as an option to give to donors. Plan gifts are a great way to build endowments. Lots of donors are thinking about plan gifts and estate planning now, as Margaret mentioned. Baby boomers are just about past their peak earning years and now are at their peak estate planning years, which is generally in their 60s and 70s. So it's a good time to get on their radar, even if they don't make any final decisions right now. Now is a good time to start to cultivate things. And the last point is that, and there may not be a diplomatic way to say this, but many donors are feeling financially good right now with how good markets have been doing. And the one stat that I like is from the Wall Street Journal. Americans age 70 and older had a net worth of 35 trillion at the end of the first quarter of 2021. And that amounts to 157% of GDP, which is more than double the proportion from 30 years ago. So older Americans are essentially the wealthiest that they've ever been.
It's,
Annie, let me throw it back to you.
well, that certainly sounds like a good opportunity. Nick, what do you think is the best starting point?
I do think there's lots of different ways to get started. I'm a proponent of having a good solid infrastructure established before actually actively seeking plan gifts or endowed gifts. I think we talked more about that on the next slide, actually. I think another really good first step is to write a separate case statement for endowed support. Internally, a case statement is a great way to organize your thoughts and just get all of leadership on the same page. But it's powerful externally too. It's basically preparation for the questions you'll get from donors to justify their support. So those questions can be things like, who do you serve? What challenge are you addressing? Why is endowed support specifically a solution? What's your reputation as an organization, and how will a gift be acknowledged? You could ask yourself these questions as a good starting point, and then facilitate that in communicating that to donors.
Great. So we touched on the fact that plan gifts kind of go hand in hand with endowments because they are a great way to build up the value of an endowment. Nick, what are some strategies that organizations can use to promote plan gifts?
Yeah, so I mentioned having an effective infrastructure in place. What does that mean? Policies, investment policies, spending policies, gift acceptance policies, those are all very important. Donors are going to do their research, so you're going to want to be prepared. Endowment policies are a part of this. They should have, that's the type of policy that should have rules for minimums and stipulations that you want to have for making an endowed gift. You should have a template for endowment agreements. That's effectively a contract with a donor for an endowment gift. So having that in a good place is important too. Databases are super important. You want to be able to track as much as you can about your donors. And the rule of thumb for plan gifts are donors who are probably in their 50s or 60s and have given consistently for at least 10 years. It's great to be able to track that. It's great to be able to pair that with any affinity info that you have. What is someone's relationship to your organization, and then maybe put that all together into your own donor rating for plan gifts. That's a great way to start the cultivation process. And then marketing is a part of that infrastructure too. Websites, brochures, newsletters, email signatures. Donors should know that plan giving and endowed gifts are options for them. The biggest leap that organizations choose to make is probably from a passive approach of just sort of accepting the gifts that come to you to a much more active approach where you are actually implementing the fundraising cycle to identify, cultivate, ask, and then steward your donors. It's a big leap because it takes resources to do that. And the main thing I'll say about that is that the most effective organizations, when they want to take a more active approach, they have an excellent partnership between board members and staff. Both have their roles. Most asks for a plan gift come from a board member. It's especially good if it's a board member who's leaving their own gift and they can speak with authority as to why, and they can tell their story as to why. But when you have a good balance for the workload and you have both board and staff sort of working in the same direction, it's definitely possible to take a much more active approach. And Margaret, I know we've talked before about advice that fundraisers can sort of pass through to their donors. What do you think on this question? What are some ways to educate on plan gifts and get donors interested?
Yeah, you touched on it right there. I think just keeping in front of donors and letting them know it's not necessarily just writing a check each year. You have other options if something would work better for you. So touching back on the fact that most people don't itemize their tax returns anymore, there's ways that you can do other types of gifts to still get a tax benefit, even though you might not be able to get an income tax savings. on your tax return. So this includes just, letting them know, hey, maybe you make a gift from an IRA instead of writing a check. You could open up a donor advised fund. And for example, we had a client who had just made a 5-year pledge to an endowment. And we said, okay, well, why don't you put those 5 years worth of appreciated stocks into the donor advised fund? That way you can get the charitable deduction this year all at once. And then you're still fulfilling the pledge on an annual basis going forward. She had no idea that that wasn't even an option. So I think just letting donors know on a regular basis, here's the different ways you could give, here's kind of the basic advantages of each. And then the second side of that is constantly reminding clients or donors when the opportunity arises. So maybe at this start of the year, sending a reminder out about gifts of IRAs, required minimum distributions, because that's when people are kind of setting up their withdrawals, for example. So, and also you touched on a partnership. Another important part of that is if you don't have the resources to be able to educate your donors yourself, Nick and I went and hosted a panel discussion for one of our foundations that we work with for their donors. Or attorneys are always happy to do it as well. So just finding ways to educate them and reminding them of different options.
Those are all great strategies for organizations to utilize. And well, now that we've touched on how planned gifts can help grow endowments, another factor in growing endowments that's important to consider is the market. So, Paul, what does the future hold for investment markets?
Well, I would start by saying that the old adage of how the economy does not equal the stock market very often, that holds true in both directions. In 2020, the economy was in the dumps. There was soaring unemployment, so much COVID-driven uncertainty. But by the middle of the year, the stock market had basically completely bounced back, and it was off to the races far before the economy was. Fast forward to this past year and currently in 2022, the economy is thriving on virtually all measures. And yet we've seen a more volatile market environment to start this year than we've experienced really in several years. So this mostly boils down to the fact that markets are forward-looking and therefore can be very much out of step with economic realities. The reality right now is that although the economy looks great, we need to always be looking forward. And on the flip side of a very hot economy are some of the risks that we see currently rising on the horizon. The biggest elephant in the room, obviously, is inflation, which has stuck around quite a bit longer than many initially thought and hoped. We saw again just this morning that it remained stubbornly high again in January. There's a lot of ongoing debate still about what has been sort of the primary source of inflation, whether it be simply too much demand in the economy and simply too much consumer strength and disposable income, or supply chain issues, or a combination of both. So regardless, there unfortunately is no easy solution to inflation, as there are a lot of factors at play combining to sort of drive the inflation. What we do know at this point is that the Federal Reserve is going to act by tightening their balance sheet and raising interest rates. We know that the markets are preparing for this, and frankly, markets have already been reacting to the expectation of this tightening. What it means is an end to a lot of the accommodative, easy money policy that the economy and the markets have gotten used to really over the past couple of years. And that change, that shift in the tide comes with ramifications. So we're expecting markets to bounce along a pretty bumpy road over the next year or so as the Federal Reserve tightens. And the idea of that is to deal with inflation, interest rates rise, and as markets sort of digest these changes, we're expecting volatility. That's the negative, that we do expect the volatility and a challenging environment moving forward. But the positive side is that this type of environment does not necessarily have to mean a stock market crash or even a flat market necessarily. Historically, stocks have actually delivered average to above average, perfectly satisfactory returns in many rising rate environments. That's not to say that history is necessarily a perfect predictor by any means, but we do believe that opportunity still exists and remains in the stock markets right now, especially if you look out over a multi-year time frame and have a longer term time horizon. One other thing, it's also important to remember that rising interest rates aren't completely a bad thing for bonds either. They can cause some short-term pain, absolutely, for bond investors, due to the inverse relationship between bond prices and interest rates. But as rates rise, the opportunity also arises to reinvest money at more attractive rates. So similar to how stock market volatility presents opportunities to buy stocks at more attractive prices, the same goes for the bond market, as rising rates presents volatility, but also opportunity. Again, this isn't to discount the likelihood of continued volatility in the near term. We think that is likely. There's likely to be a decent amount of trial and error also from a policy perspective, which itself is another factor that increases the potential for more volatility, like we've already seen this year. But effectively, we do have this sort of conflicted environment right now where the economy is really, really strong. The consumer is really, really strong. Companies are doing very well still. They've been able to pass through inflation to consumers without skipping much of a beat. But as a result of that, we do have this inflation. Stock prices are high, rates are low and rising, and we see generally a more risky environment right now.
We are certainly living in interesting times when it comes to the markets. Paul, what does this all mean for nonprofits and how organizations should be thinking about navigating the uncertainty?
Yeah, the biggest thing I would probably emphasize is really to stay invested. When markets enter periods of volatility, it's a lot of times very difficult to maintain the discipline to not run towards safety. But that almost never works out for the better. And it's a lot easier said than done in many cases. But it's important to remember that if your assets or your organization's assets are invested with a goal of growth over the long term, then the long term is what matters, not necessarily short-term noise. Along those same lines, a strategic approach to how your assets are invested should inherently really balance the organization's longer term goals of growing your assets, balance that with your current needs as far as supporting the organization or whatever other spending needs that you have right now today. Nonprofits, they have a need to grow their assets, but also to support that near term spending. And right now we're in a challenging environment for generating returns, quite frankly, needed to meet those objectives. And this comes back to the need for really a strategic, flexible approach to your overall investment program. Flexibility not only to adjust portfolio allocations to the changing market environment, changing market conditions, but also to actively identify specific areas of opportunity and avoid specific areas of excess risk. All of these are important aspects of an approach focused on meeting your goals despite the market environment, really, managing through different market environments in the pursuit of your long-term goals. This goes for equities, where different market segments can present very different risks and opportunities as well. And also for the bond market, where, like I mentioned before, a solution to navigating a challenging period of rising rates is really to be able to find attractive opportunities in the near term. And as rates rise and as you progress through an environment, to adjust that portfolio to take advantage of those higher rates and actively manage the fixed income side of things in that way. A lot of these are pretty timeless suggestions and reminders in a lot of ways, but they do in a lot of ways we appear to be entering a period right now where they're likely to be as important as ever for investors to remember. And and you know, these different ideas carry on throughout different market environments, but given the conditions that we're seeing right now, they appear to be as important as ever.
Thanks for sharing those helpful strategies, Paul. Another concern that many of our nonprofit clients have expressed to us is that engaging donors during a pandemic has been a major challenge. So what is on donors' minds today? Margaret, can you share some insight here?
Sure. So I think Nick touched on it earlier. It's been very hard because there's not in-person events. You know, there was proposed tax changes at the end of last year that never ended up getting passed. So we don't really know what's currently going to be passed for this year, if it's going to be retroactive to the start of the year. And obviously, Paul just went over the market uncertainty as well. So there is a lot of donors sitting there and saying, when should I give? Should I give now? Should I wait? What should I do? And if a donor wants to give, they're going to give. But you can help them kind of figure out ways to do that more efficiently for their own situation, and kind of dampen some of these uncertainties that they can't control. For example, taking advantage of high estate tax exclusions when it's available, but otherwise, you know, find a way that maybe won't be impacted by changes to tax laws. For example, going back to qualified charitable distributions or QCDs from IRAs. Clients, donors never have to pay income taxes on that, regardless of whether or not they itemize their tax returns. In addition, if they take the standard deduction, then they get another $25,000 deduction. You generally want to avoid taking a large withdrawal, obviously in down markets, but you know, maybe in up markets, send an email as a reminder, hey, good time to do your donation from your IRA. Also, we kind of touched on bunching donations in my earlier example of my client who did a 5-year pledge all at once into a donor advised fund. So in up market, she has highly appreciated stocks. We got those in there when the price was high, and now she has cash and now she's diversified into additional areas of the market within the donor advised fund. So she's going to ride out the volatility better than if she just kept the stock and donated it little by little. And Nick, I think that kind of gives you a little bit of an idea of a donor's mindset. I guess the other side is, how do you actually engage donors today with those things in mind?
Yeah, it's good insight, Margaret. And from my perspective, it's a weird time. And this is different for different parts of the country, but no one really knows what's socially acceptable as far as engagement goes. And so it's probably a good idea to have a variety of opportunities, you know, virtual and in person, volunteer options, events. I'd say diversify and have backup plans as far as the actual logistics of like how you engage with your donors. I think follow up with lapsed donors, or maybe try to find out why they've lapsed. That's always a good practice, of course, but while giving has been growing, one worrying trend is that a smaller percentage of people are giving. And so if that's been the case for you, it might be worth finding out why. I'd ask what your donors want, and then really listen to the feedback they give you. You know, ask them what can you do for them that's better? What's changed in their lives, and how has that affected their giving and their preferences? Then use that insight to make adjustments for what you're offering. You know, kind of like you do with a focus group. I'm of the opinion that asking questions and then valuing your donor's opinion is in itself a great way to build relationships. And it's a tactic we use all the time at Manning & Napier. And this is a good spot to mention, there will be a survey at the end of the webinar for you all to fill out, so we can all get your feedback. But there's that, and I think it's a good idea. And you know, one more thing I'll say is regarding the tone of your communication. I do think people are over negativity. I think the pandemic is probably still the number one issue on most people's minds, but I think there is an opportunity for organizations to take a positive tone today in how they communicate. It'd be great to say something like, we did a great job in 2020 and 2021. Here's what we did. Help us continue that into 2022. This is one of those areas where it might be good to take the pulse of your donors and reflect back to them what you see, whether they're in more of a negative mood or a positive mood. But I do default toward the positive because that's inherently just more attractive to people and a bit of a breath of fresh air today.
Thanks, Margaret and Nick. I think all of those are very helpful takeaways for organizations to stay connected. Another question that we're often asked is how board members can be good fiduciaries when it comes to the investments of the nonprofit that they serve. So Nick, when should an organization reevaluate their investment program?
Yeah, so I mentioned before about optimization. Many organizations are taking a fresh look at their investments, and when they're doing so, board members do have those important duties they should be aware of. They have the fiduciary duty of care, loyalty, and obedience. That's the guidance the law gives you. So what we suggest is having a formal process to evaluate things and then help you meet those duties. And so up here we have some good questions to get you started. Are you meeting your goals? Look at your policy, look at your results, look at the environment, and assess how you're doing. Are we getting the right level of engagement? What are other support services that are available? By now that we're big proponents of well-rounded planning and added services. And then this is a good question. Are we getting good value for the cost? The threshold here isn't lowest cost. The threshold is value. Are you getting good value for what you pay? The most direct way to measure this is your after fee return or net of fee return on investments. That should include all the different layers of fees that you might pay, because many times there's an advisory fee, and then there also could be a fee on the underlying investments you're using. And then also take into account the advice you get too, because you can have good returns, you can have good net of fee returns, but if you aren't getting the advice, or if it's bad advice on things like policies and allocations and withdrawals, things like that, then you really might not be getting good value overall. So take into account results, the service, the advice you're getting, and have that be the way you evaluate your investment program and see where you stand today.
So where do requests for proposals fit into this, and how does someone know if they're ready to do one?
Yeah, you might be ready for one depending on the answers to these questions. It's common for organizations to put a formal spin on their evaluation by doing an RFP. I'd say it's common and good practice to do one every 3 to 5 years. It is a good way to bring new board members up to speed on all the options that are out there, and it gives you a good point of comparison for how your portfolio is managed today. I'd say a formal reaffirmation of your policy. Do that, once per year, and then do a formal RFP every 3 to 5 years, or sooner if you need to. I think that's good practice. And again, it doesn't mean you have to make a change, but it just means that you're doing a formal evaluation for both your policies and then a full RFP if needed. So that's what we suggest to our nonprofit clients today.
Thank you for that insight, Nick. And this actually marks the end of our prepared remarks for today. So if you have any specific questions for our panelists, feel free to add them right now into the Q&A box at the bottom of your screen, or feel free to reach out to us directly after the webinar. As Nick touched on a few minutes ago, we have also included a link to a survey in the chat, and would really appreciate any feedback that you have, either on our speakers today or on the content of the webinar. And at this time, we can begin answering some of the questions that have come in. So I think, Nick, I'm going to direct this first question to you.
Yep.
How do you feel that the proposed Accelerated Charitable Efforts Act will impact future philanthropic work of donor-advised funds? Do you contend the new requirements? Should they be adopted, and will they have a negative or positive effect?
Yeah, I'm glad this was asked, because that ACE Act is probably one of the things that has a better chance of being passed, because it is bipartisan. I'd say there's provisions in it that probably make sense, frankly. You know, putting limits on DAFs, donor advised funds. Right now, there's no time limits on when to use up DAFs. There's no spending requirements on DAFs, and so most are spent pretty quickly. But you could see a bad actor taking advantage of the current rules. So I think there is a bit of a loophole there that the act aims to close, and it might be a good idea. I don't think there will be a huge overall impact. The one other thing I know of are new rules for private foundations, and it might make investing them a little bit more complicated if they end up having to spend more, but also still have a mandate to be perpetual. You can see assets shrink if that's not effectively managed. But I guess the main point, and maybe my main criticism with an act like this, is not to lose sight of the connection between perpetual giving and perpetual missions. The main point of the legislation, the ACE Act, seems to be to get more money into the hands of nonprofits. But for some philanthropists, the concept of equity between different generations is important. The concept of supporting not only the current generation, but wanting to support future generations as well. And I just guess that perpetual support shouldn't be seen as inherently a bad thing, because that actually aligns very well with what some organizations need and want. And so I hope that's something that's taken into account.
And I think from the donor side of things as well, you kind of hit on it. Most people are funding a donor advised fund with the intention of making gifts on the nearer term. So I know the ACE Act was, making a 50-year donor advised fund and changing the rules for that, where you wouldn't get the income tax deduction until the donor advised fund actually completes the gift to the charity. But in the meantime, you're still getting savings on the capital gains side of things. So once you fund it, any trades won't be taxable to the donor that funded the DAF. So I mean, that's great for multi-generational giving. You still get to avoid the gains. It's still taken out of the original donor's estate, but you're still able to engage with the whole family on when to gift. And I think that's really important for an organization is trying to get the parents to engage with the kids and make plans like that. But otherwise, the ACE Act is talking about a 15-year limit to kind of keep the same tax rules. And I think that's perfectly reasonable for what most people are using a donor advised fund for.
Great. I think I'm also going to direct this next question to Nick. Our board, which manages the investment portfolio and endowment funds, currently uses the Yale rule, which has a built-in inflation component to compute the amount available to be utilized by the separate operating board for operating and programmatic expenses. Any comment or opinion as to the use of the Yale rule for this purpose?
Yep. So that's a hybrid rule, part percentage based, part indexed to inflation. I think you should use the rule that best fits your needs. I really think the number one purpose of most spending rules is to allow you to spend enough to meet those needs. But then probably the number two purpose is to prevent you from spending so much that your portfolio never grows, if that is indeed a goal. So when markets are down, you should know that the Yale rule would tell you to spend more compared to a purely percent-based rule. So I would think about your expenses. The question mentioned programmatic expenses, and I would choose the rule that best matches your priorities there. So ask yourself, should the emphasis be on spending, or should the emphasis be on growing that spending, or do you have equal emphasis? You know, if it's equal, the Yale rule probably does make a lot of sense. And you know, to help you prioritize too, you know, you could do projections that's something we do for a lot of our clients, you know, to project the impact of different rules out into the future. Look at a number of different scenarios. If the market goes up, if it goes down, or if it stays sideways, and then see how those rules behave under those different scenarios, and then choose the one that just maximizes the outcomes that you want to see. That's what I would suggest. But know that the Yale rule is a little bit more. It does lean a little bit more towards prioritizing spending than a purely percent-based rule.
All right, Paul, I think I'm going to direct this next question to you. Our current investment policy is weighted towards equities. We are a non-for-profit charged with the preservation of principal in order to fulfill donor wishes and fund programs into perpetuity. Should we revise our policy toward a more conservative approach?
That's a great question, because especially it applies really to a large majority of nonprofits probably that have those two conflicting objectives that are in direct competition with each other as far as supporting causes and organizations in the short term, and growing your assets to be able to do that for as long as possible. I would say firstly that it's probably not appropriate to have an all equity portfolio without, you know, any stability mechanism or focus on preservation whatsoever, but it doesn't sound like that's necessarily the case here. Having a lean toward more equities than fixed income, which it does sound like may be the case in this situation, that often does make sense, even in uncertain environments like we're in today. Everything is pretty expensive right now, not just stocks. So while fixed income, it can provide a certain level of stability and liquidity and diversification, organizations still need to meet those longer term goals to be able to spend in the near term, but also grow their assets over the long term, to be able to lend support into perpetuity. So pursuing too conservative of an approach, that can seriously put into jeopardy the ability to meet those goals. You know, by becoming too stability oriented and forgoing, you know, greater return potential that is needed over the long term to meet those longer term goals. Every organization, I would say, has unique needs and unique goals, but broadly speaking, a balanced approach between growth, or equities, in other words, and stability. You know, even a portfolio like that does have more exposure to stocks than it does to bonds or cash and so forth. You know, even in today's environment, because of that need to pursue growth over the long term, and we do see opportunity in the equity markets to generate return, especially over a multi-year time horizon. You know, which is what's important to meet those long-term goals. I think it remains generally appropriate right now, that type of balanced portfolio for an organization like this.
Hey, Nick, I'm going to shoot this next one back to you. How do you find good investment managers to send an RFP to?
Yeah, board members and staff are going to have their connections, but I do think organizations can benefit from sort of keeping a running list of the service providers that you've run into in the past and who might already be familiar with your nonprofit. And, you know, when I think about like how to sort of form that list, a couple questions come to mind. Like if you value engagement, if you value a presence in your community, in your city, if you value a partner who's active philanthropically and whose employees volunteer and are generous, and they come to galas and they're out there in the community, and if you value a company that shares sort of your mission, a mission that many of you have, which is to make your communities a better place, then I think that forms kind of a natural list because you have those shared values, and there's a good chance that because you have shared values, you've run into them in the past. Whether it's attending events or attending networking events, you can refer back to organizations that you've run into in the past that are already on your radar that have those shared characteristics. And I'll tell you honestly, for business that we've competed for, these are things that boards take into account when making a decision. Are you going to be working with people who are leaders in your community? And the leaders are visible, and usually they find you. So that's what I'll say about getting a good list put together to send an RFP out to.
Margaret, I'm going to direct this next one to you. Is there a general belief that over time charitable giving will decline due to the increase in the standard deduction?
Oh, that was a concern when the Tax Cuts and Job Act was first passed, and there was kind of a dip the year afterwards when people were still trying to figure out what was going on. And I think Nick has a bit more stats on specifics of donor versus endowment in terms of total giving each year, how much is made up of endowment giving versus how much is individual donors. So that kind of goes back to finding other ways to help donors figure out how to still get a benefit, even if they're not able to itemize their tax returns and get the charitable deduction that way. So gifting appreciated stocks, you're still avoiding the capital gains on those appreciated stocks once they're gifted. Going back to QCDs, qualified charitable distributions from IRAs. And that's why educating donors is so important. But Nick, I might hand it off to you in terms of the trends on the donors.
Yeah, I don't think it hasn't had much of an effect. I don't think it will have much of an effect. Giving has been remarkably consistent. It's usually about 2% of GDP, and it's about 3% of people's income every year. It's been pretty consistent over time. And what might change is sort of the format that gifts take. Like you said, Margaret, like bunching donations makes a lot more sense now if the deduction's higher. Larger gifts, it makes a lot more sense to do larger gifts now that they're higher. Every person has an individual situation and incentive, and everyone has their own incentives that change depending on the laws that are out there. But overall, in aggregate, I don't see it changing much. And indeed, giving has still continued to be very strong over the recent years where the deduction has been higher.
Yeah, I think that either you're charitably inclined and you're going to give no matter what, or maybe with some extra perks, if you get more tax savings, you might have more to give. But in general, you're going to give no matter what.
The fundraisers on the call would probably say, the number one thing is always the relationship, the affinity that you feel, and really the financial aspects of giving are just sort of icing on the cake. To people choose the timing and the format of how they give, but charitable people will find a way.
All right, I'm going to shoot this one over to you, Nick. For endowed giving, how do you get over the hump of the first gift? The idea that donors are more likely to support if assets are in an endowment already there and well established.
Yeah. It is a bit of a chicken or the egg situation, because I agree that there might be a little reluctance to support something without a track record. I think there's a few tactics. I think I think starting an endowment is your chance to make a real polished case for support. And one thing you could do if someone has this concern is, you could say, thank you for showing an interest in our organization. We understand that part of having an endowment is giving our donors confidence that that we will be good stewards of your legacy. And would it be all right if I shared details of how we're doing that exactly? And then make your case. And some organizations will walk donors through their financials. They'll say, here's our cash balance, here's our reserve fund, here's our board designated fund, and we are a financially strong organization, and here's the proof, and here's our track record. And just now, now we're looking to expand our support. So coming at a donor from a position of strength is important, I think. I think having all the policies in place ahead of time is a good idea. Of course, we talked before, the case statement, investment policy, spending policy, and like a procedure for monitoring an endowment. That's really important. Many organizations report back to donors the details of their endowed gift, what the balance has been and how it's been spent. Sometimes it's kind of like an annual report that a donor receives. So that's great to be able to offer. And then there are legal protections, and use your discretion for how you phrase this. But the one thing that can give donors comfort is that there's a formal gift agreement in place, and you can tell them, we are legally obligated to follow your intent and manage this prudently, and your money is in good hands. And so hopefully those things can give a pioneering donor comfort that their money is indeed in good hands.
Yeah, and also jump in, going back to, encourage donors to involve their whole family. So if a donor gives a big chunk of money, sometimes they're really tight-lipped about it. They don't want to tell their kids, or just don't think of mentioning it. So kids don't even realize that their parents were involved with certain organizations. Whereas if they were aware and knew how passionate a parent was about being involved with that organization, they're more inclined to keep being involved themselves afterwards. So again, multi-generational, just kind of encouraging parents to actually tell their kids what they're doing.
Yeah.
All right, well, we're coming up on 1 o'clock, so I think that's all the time we have for questions today. But if we did not get to your question, we will have someone follow up with you. As a reminder, a recording of this webinar is going to be available on our website within the next several business days. Manning & Napier has a dedicated section of our website just for nonprofits. This is where we publish our monthly blog posts, our quarterly webinars, and any other thought leadership that we have. If you're not already subscribed, feel free to sign up to receive these complimentary resources. We have a link to sign up right here in the webinar slides, or if you would like to reach out to us, we're happy to sign you up ourselves. Thank you again to our speakers, Nick, Margaret, and Paul, and thank you all for attending. Have a wonderful rest of your day.